Hi, welcome to this next lecture for Ratio Analysis for Beginners. This lecture is about 4 rookie areas that you need to avoid. Okay, everyone makes initial mistakes, but we're going to discuss 4 common areas that you can now avoid. And remember that expertise is a lifelong, ongoing process. So while I'm going to talk about areas you may make, don't be paralyzed by the fear of making mistakes. After all, experience, the best teacher, gives you the lecture after the test. So let's move on to these areas. Okay, rookie area number 1. There are no standards in ratio analysis. Now, what you'll find in your accounting knowledge journey is that much of the financial accounting information is based around following a set of formal standards or rules. Financial accountants are trained about how to measure particular transactions a certain way. These are known as standards or generally accepted accounting principles. So while ratio analysis is based on financial accounting information, you'll find that there are no set standards for ratio analysis. There are no rules when it comes to ratio analysis. Thus, you may find that ratio analysis formulas can be different depending on the source that you seek the formulas from. And you'll often find that ratio analysis service providers can provide different data. Often some websites or some services offer the ability that they conduct the ratio analysis for themselves and just provide you with the results. You may find that 2 different data sources provide 2 different ratio analysis results, or different types of information. There are no rules when it comes to ratio analysis. So what's the guidance for this situation? Firstly, you need to choose a consistent, reliable provider of your information and services. If you find a good provider, try to stick to it, and try not to mix and match and cross-match results from different sources. If you find results from source A and results from source B, try not to compare them against each other. Try to use 2 results from source A or 2 results from source B. Alright, secondly, accounting methods can affect your data inputs. So while ratio analysis is about inputting data and performing calculations on them, you'll often find that while there are standards for recording financial accounting transactions and data, these standards and rules do offer a little bit of flexibility in accounting policy choice. While they are rules, they try not to be too prescriptive. What this means is that across businesses, and even within one business across time, the ratio data inputs that you plug into your formula can be affected by accounting policy choices, and even accounting information manipulation by the management or the CFO. As an example, you may find different depreciation policies or different ways companies measure their assets. You have to be aware that accounting methods can affect your data inputs. What's the guidance here? Well, if you really wanted to get into the nitty-gritty, you can always read the notes to the financial statements to understand particular accounting choices. The notes to the financial statements are found in an annual report or a financial report after all of the standard financial statements. And that's the real nitty-gritty. It outlines all the accounting policies. Or, a more simple solution is to make sure that your decisions are based on clear-cut variances from analysis and nothing too granular. So if you're choosing between an investment in 2 different companies, make sure that your ratio analysis interpretations are clear-cut. Perhaps a profit margin of 50% versus 20%, as opposed to a profit margin of 19% versus 18%. Now that's a very basic, straightforward example, and not really that practical in the real world. The key idea is to make sure your decisions are based on clear-cut variances, nothing too granular, and this will remove any slight variations created by the different accounting methods between 2 businesses or the same business across time. As for the third rookie error, don't rely too heavily on a single ratio. it can be easy to recognize one particular good or bad ratio result or one ratio across time and quickly leap to conclusions. Ratio analysis has optimal outcomes when you can draw as complete a picture as possible about a business. And this isn't normally achieved with too heavy a focus on one favorite ratio. Your idea is to get a complete picture, an overview, to know what's going on internally and externally with all the strengths and weaknesses. One ratio just won't provide this outcome. And here's the guidance. Use as many ratios as practical to gain that context I was just talking about. Look for the dependencies and relationship between ratios. Many ratios affect other ratios. And by having multiple ratios in your analysis, you get a more complete picture. And don't forget to see the earlier benchmarking is the first step to ratio analysis lecture that was covered just a little bit earlier. And as for the fourth area, major firm changes over time can strongly influence ratios. You have to be aware of this. Now, all firms naturally change over time. Even look at the modern firm Netflix over the last 10 years. Now, Netflix is a very new company. You wouldn't think it's changed much over the last 10 years when you compared it to perhaps Ford in the early 20th century and Ford today. But even Netflix has changed from postal DVD distribution in the late 1990s and early 2000s to now content streaming and production in the modern times. And even look at this change in business model, how that would affect the particular financial statements and resultant ratios. And the more a firm changes in regards to the nature of the firm, for example Netflix, or business strategy, or the capital structure, a mix between debt and equity, the more the ratio results will be distorted over time. So here's the guidance for this era. Keep your ear to the ground. Look for news and events outside of the financial statements and outside of your ratio analysis that could indicate a major firm change. Even at the very most basic, just look at the annual report external to the financial statement section. And be aware that the longer your ratios are benchmarked across time, the more all businesses will naturally change. Always have a look out for particular changes that may flow into the financial statements and affect your ratio analysis. And here's a final word of comfort in regards to this final rookie era. With education, practice, and experience in ratio analysis, the actual process of ratio analysis will make it easier for you to spot these major firm changes over time. This will actually be a source of information as opposed to being a source of error. So you'll start to pick things up from your ratio analysis as you become more experienced in this field. Thanks very much for your time.